Good afternoon, everyone. I would like to welcome you all to today's BankDhofar MSX discussion session, where we'll be discussing the financial performance for the first half of 2024. Joining me today, we have our Deputy Chief Executive Officer, Mr. Gopakumar, our Chief Islamic Banking Officer, Mr. Kamal, and our Chief Financial Officer, Mr. Vikesh, and the IR team. Head of the IR team, Hilal Al-Arabi, Sidda Salawati, and myself, Maram Al-Hadrami. Also welcoming our new fresh graduates from our Ruwad program and students attending from several universities in Oman. Starting today, we'll go through our presentation to discuss the financial performance, followed by a Q&A session. I will now pass it to our Chief Financial Officer, Mr. Vikesh, to take us through the investor presentation.
Thank you very much, Maram, and good afternoon, everyone. As Maram indicated, I would like to welcome you all for our earnings call today, in which we are going to cover the June 2024 numbers for BankDhofar. Moving on, a quick disclaimer: we will be shying away from making forward-looking statements. The agenda that I'm going to cover today is around BankDhofar overview, highlights, and financial performance. We'll be looking at the operating environment of Oman and the Omani banking sector. With that, we'll move to business strategy and also look at segmental performance for the bank. Deep diving into the financial performance for both BankDhofar as well as our Islamic window, which is Dhofar Islamic. And with that, we'll be concluding the presentation and then opening it for Q&A. Moving on, slide number 4 shows BankDhofar's performance at a summary level as at the end of June 2024. Our total income stood at OMR 78.16 million, which is an increase of 5% as compared to last year. Last year, same time, June 2023, stood at 74 million. Our net profit at 22.11 million was higher as compared to last year by 20%. Our net interest margins at 2.27% improved by 3 basis points as compared to the same period last year. Return on assets at 93 cents was higher by 10 basis points as compared to last year. Our return on shareholders' equity improved by 121 basis points to 7.93%. And if I were to include the 81 interest, which is the additional tier 1 interest, my return on shareholders' equity stood at 6.11%. Our net loans and advances as at the end of June 2024 stood at 3.73 billion. Compared to last year, this is an increase of almost 9%. Deposits, again, a good story with 3.55 billion, increased by almost 15.5% as compared to last year, an increase of almost 480 million, most of which came from the increase in CASA deposits. Total assets at 4.84 billion as at the end of June 2024. With the continued investments in increased branch network as well as new businesses, our cost-to-income ratio increased by 2.8% to 48.3%, with ECL coverage ratio at 89%, higher by 70 basis points, and capital adequacy ratio, with increased in overall lending book, stood at 17.25% as at the end of June 2024. We have 13 nationalities of full-time employees working with the bank. 50% of our employees are women, so we've got a very good gender balance. We have the fastest growing branch network in Oman, with 119 branches for both conventional as well as Islamic. We are rated by both Moody's and Fitch, with Moody's rating us at BA1 with a stable outlook, and Fitch very recently affirming our ratings at BB with a stable outlook. Looking at the This slide shows the overall branch network within the geography of Oman. We are, as I mentioned, the fastest growing branch network in Oman. In fact, we were awarded as the fastest growing branch network by OER Business Summit. We currently operate out of 119 branches with 95 conventional and 24 Islamic branches. Our total ATM CDM spread is at 333 machines with ATMs at 212, CDMs at 40, FFMs at 77, and multifunctional kiosks at 4. Our market share for assets and loans stood at 13% and deposits at 11%. The map that you see in the middle of the slide shows the geographic spread of our branches across Oman. As at the end of June, our total number of customers stood at 600,000. Just to give some context, just 18 months ago, our total number of customers were at 267,000. So we have seen a phenomenal increase from 260,000 to almost 600,000 customers over the last 18 months. Branch network, as I mentioned, at 119, just in 2024 alone, our branch network went up by 11 more branches, 9 for conventional and 2 for Dhofar Islamic. We have been following this as a strategy, allowing us to have a greater reach to our customers with expanded products and new business opportunities with which we are reaching out to our customers. These are broadly low-cost branch models wherein which we have redeployed our staff, optimizing both capacity as well as cost. Needless to say, this has helped improve our CASA, as you have seen in the overall deposit growth, increased business volume, as well as increased customer acquisition numbers, which, as I mentioned, stood at almost 600,000 customers as at the end of June. Moving on, again, looking at the balance sheet, the income statement, as well as some of the key ratios, our net loans stood at 3.7 billion as compared to 3.4 billion last year, an increase of almost 9.2%. Investment securities increased by 90 million to 533 million, an increase of almost 20%. Our customer deposits, as I said, a great story at 3.551 billion, an increase of 15.6% year on year, most of which came through increase in CASA. If I look at the income statement, our operating income increased by 5.3% from 74 to 78 million. Expenses with increased branch network as well as investment in new businesses went up by 11%, leaving the profit before impairment and tax charges largely flattish at 40 million. We have seen improved cost of risk with which our impairments went down from 19 to 15 million, giving us a net profit of 22.11 million, an increase of almost 20% as compared to last year. Total capital adequacy ratio, as I had shown in my first slide, at 17.3 or 17.25%, with CET1 ratio at 12.9%. Our NPL ratio stood at 5.11% as compared to 5.9% last year. Return on shareholders' equity at 7.9, adjusted for 81 at 6.1. Our return on assets at 93 cents, margins at 2.3%, cost to income ratio at 48.3%, and our net loans to customer deposits reflecting improved liquidity at 105% as compared to 111% last year. We continue to be one of the leading listed banks in Oman with a total assets of 4.84 billion and 1,737 employees as of the end of June 2024. Next slide shows the P&L construct, largely looking at total income, operating income, as well as net profit over the last 10 years. We started our operations in 1990, almost 34 years ago. This shows the P&L for the last 10 years. As you can see, we had the highest total income at 144 million as at the end of 2023, which stood at 78 million in the first half of 2024. Our operating profit stood at 75 million last year, which again was the highest over the last 10 years and stood at 40 million as at the end of June 2024 in the current year. Moving on, this slide shows the shareholder structure, which is broadly the same as you would have seen in my previous presentation. We continue to be owned by the quasi-sovereign social protection fund as well as pension funds to the extent of 28%, giving us a good, stable, sticky relationship with sovereign and quasi-sovereign entities. Our total asset segmental split and the total operating income segmental split is what is shown in the bottom of the chart, with total segmental assets, corporate banking contributing to 40%, Dhofar Islamic at 19%, treasury and financial institutions at 15%, and retail banking at 26%. The operating income pretty much mirrors the segmental split on assets, with corporate banking at 47%, Dhofar Islamic at 14%, treasury and financial institutions at 10%, and retail banking at 28%. This slide, which is slide number 9, shows various achievements of the bank over the last 34 years since the inception in 1990, focusing on the latest 2 years, which is 2023 and 2024. We had a successful issuance of 40 million of Tier 1 securities last year in 2023. We rebranded our Islamic window business to Dhofar Islamic in 2024. And as I mentioned, we operate out of 119 branches by the end of June 2024, with the customer number circa 600,000 for the same period as at the end of 2024 June. Some of the key strengths for the bank: we are a leading franchise in Oman with a diversified product offering for both corporate and retail business. We are the fastest growing Islamic banking window in Oman, and recently, in fact, a couple of quarters ago, started with new businesses such as corporate advisory, wealth management, asset management. We recently launched a money market fund as well as private banking proposition for our customers. Government and pension fund ownership is at 28%, as I mentioned, giving us a good sticky relationship with both quasi and sovereign entities. We operate out of a stable and growing operating environment within the country, enjoy solid and robust capitalization with our capital ratios higher than the regulatory requirement. We have a diversified and smart distribution channel of almost 333 machines, ATMs, CDMs, FFMs, as well as multifunctional kiosks, and of course, an experienced and seasoned management team and a very motivated staff supporting the operations of the bank. A very quick overview of Oman, and again, I'll quickly run through it. We are the second largest country in GCC in terms of the total area, enjoying a stable political system, population close to almost 5.2, with Omani nationals at 65%, enjoying a resilient and a solid economy. Next slide, looking at the banking sector, Oman comprises of almost 20 licensed banks with 16 conventional commercial banks, 2 state-owned specialized banks, as well as 2 full-fledged locally incorporated Islamic banks. The graph that you see on the bottom left shows the assets, deposits, as well as the loans of the entire banking sector, with assets at 43 billion, loans at 31, and deposits at 30 billion as at the end of May 2024. The graph on the bottom right is the Islamic banking assets, which again has shown the fastest growth in terms of CAGR at 8.7% over the last 5 years and stood at 7.66 billion as at the end of May 2024. This slide, which is slide number 13, sums up our strategy in one page. What you see is our purpose, our strategic pillars, as well as our priorities. Our purpose is to become the most preferred banking partner trusted by customers for exceptional services. We are a relationship-led bank, a bank that is easy to deal with, thinking long-term, as well as a bank that is responsible and secure. With customer being the center of our strategy, it is supported through investments in digital engagement, improved performance culture. We continue to invest in future-proof technology, as well as improved operational excellence. Some of the strategic imperatives that the bank has undertaken includes enhancing our digital channel as well as digital engagement hub, branch expansion that I talked about, customer acquisition again being a key part of our strategy, process improvement, cost optimization, operational excellence through automation allows us to continue to invest into the business. We continue to focus on risk management as well as information security, looking at new business opportunities, which I briefly mentioned, including corporate advisory, wealth management, asset management, private banking business, which you'll hear more often from us in the coming quarters. Staff development continues to be key, both retention as well as attracting best talents to work for the bank. Next slide shows the digital banking landscape, the launch of multifunctional kiosks, as well as the cash recycling machines, which was done over the last 2 years. We also launched soft POS for our merchants, a new mobile banking app, as well as a new mobile banking experience for our customers, with digital onboarding experience for our customers, API integration with ICICI Bank, allowing our customers to seamlessly transfer money between these two institutions, salary processing through B2B channels, as well as we launched Dhofar Pay as well as Samsung Pay in the current year 2024. Next slide shows the segmental split of our net profit revenues as well as some of the key segmental highlights. As far as retail banking is concerned, it contributed to 28% of our revenues, servicing 480,000 individual customers, offering a diverse retail set of products with priority banking, premium banking offering under Rifa as well as Riyada branding for youth, ladies, and student banking as well. Looking at corporate banking, the overall revenue contribution stood at 49%. Corporate serves 31,000 wholesale as well as corporate banking customers, offering various trade-tailored products to our large corporates, project finance and syndication facilities to our customers for infrastructure projects. Our government banking unit works very closely with both government and quasi-government institutions, mobilizing deposits from the government institutions. Our investment banking activities looks at proprietary investments, providing liquidity investment opportunities and liquid investment opportunities to the bank. Treasury and financial institutions at 9% manages funding, liquidity, as well as interest rate and exchange rate risks, works closely with the businesses, offering money market, currency swaps, interest rate swaps, options, and other currency vanilla transactions, including commodities to our customers. Dhofar Islamic services 79,000 customers and contributed 14% to the overall revenues of the bank, offers Sharia compliant products across retail, corporate, treasury, and investment banking businesses. With this, I will now deep dive into some of the key P&L as well as balance sheet indicators. If I look at the consolidated performance for the bank as at the end of June 2024 and compare it with the same period last year, the net interest financing income stood at 60.35 million, an increase of almost 5.9% as compared to the same period last year. This was on account of improved margins, which went up from 2.24 to 2.27%, as well as increased loan book that we have seen during the same period. Our fee income continues to grow and stood at 17.8 million as compared to 17.2 million. You would recall the previous calls that we have had. We had a very low fee base, wherein which our total fee to operating income ratio stood at around 14.4% as at the end of 2022, has now increased to almost 23% as at the end of June 2024. The fee income growth has come from across all businesses, including loans, commissions, trade business, cards, Islamic business, transaction banking, POS, FX, etc. Operating expenses with continued investment in the branch network as well as new business opportunities went up by 11% as compared to the same period last year, giving me a profit of 40 million, which is broadly flattish as compared to last year. With improved cost of risk or declining cost of risk, the net provisions the bank took is almost 14.93 million as compared to 18 million, giving me a net profit of 22 million as compared to 18 million last year, an increase of almost 20%. Next slide, looking at Dhofar Islamic, the operating income went marginally lower as compared to last year from 12.7 to 11.89 million, mainly because of increased cost of funding. We have seen a marginal increase or an increase in cost of funds for Islamic business, as well as the fee income was marginally lower as compared to last year. Operating expenses for our Islamic business was broadly flattish at 6 million, with net profit of the tax given slightly lower income stood at 3.84 million as compared to 4.2 million last year. Both financing and deposits have seen an increase as compared to last year, with Islamic financing going up by almost 15% from 639 to 720 million. Deposits continues to be a good story from 460 million to almost 600 million, with CASA going from 36% to 39% over the last 1 year. Gross loans and advances, as I earlier mentioned, the growth has come from both retail as well as wholesale business, from 3.6 billion to 3.9 billion. Our loans and advances went up by almost 300 million, coming both from retail as well as corporate business. Retail loans went up by 107 million to 1.476 billion, whereas wholesale lending increased to 2.4 billion, an increase of almost 194 million. The growth in loans came from all the sectors, as is indicated in the chart on the top right. Credit quality is what is shown in slide number 19. The chart on the top left shows the non-performing loans, the gross NPL ratio, as well as the absolute NPL numbers. Post-COVID, the NPL numbers increased to almost 5.87% as at the end of 2022, has since come down to 5.11%, with the absolute NPL numbers coming down to 200 million. We did a technical write-off as at the end of June in the second quarter, amounting to almost 40 million, that led to a decline in NPL ratios along with some of the recoveries that we had made. The write-off also led to reduction in the coverage ratio, which came down to 89.4%. We continue to set aside provisions on a prudent basis and look at improving our coverage ratios, and we'll look at improving our coverage ratios in the coming quarters, despite the reduced cost of credit risk as we have seen since last year. Our stage 3 coverage ratio, because of the write-off, which is what is reflected in the bottom right, also came down to 53% as compared to 62% as at the end of 2023. Our stage 2 exposure, which peaked at 840 million as at the end of 2023, has improved to 753 million as at the end of June 2024. So has the overall coverage ratio of our stage 2 exposures, that has now improved to 7.89%. If you would have seen my financial statements, the restructured account balances also declined from 540 million last year to almost 406 million as at the end of June 2024. Funding and liquidity continues to be a good story. As I mentioned in my very first slide, the customer deposits as at the end of June stood at 3.5 billion, an increase of almost 15% as compared to last year, with CASA growing from 1.36 to almost 1.67 billion. So the overall 480 million increase that we have seen in our deposit, 311 million came from CASA, taking the CASA to total deposit percentage from 44 to 47%. Needless to say, the branch expansion and the customer expansion or acquisition that we are doing has led to improved CASA balances. We have seen customer behavior of moving from CASA to term deposits taking advantage of the improved rates. However, our overall CASA growth essentially demonstrates the strategy that we were following with regards to increased branch network. Our LCR as well as NSFR stood at 165 and 114% as compared to the regulatory requirement of 100%. Next slide, slide number 21. The graph on top left shows the non-funded income as well as my other P&L construct, which is net interest income as well. 2022, as I mentioned, the total fee to operating income ratio was around 14%, which has now increased to 23%, with fees coming or growing across all our business lines, including Islamic, conventional, loans and commission business, trade, cards, FX, interest rate swaps, commodities, as well as financial institution business. We have also started various new business opportunities, particularly private banking, wealth management, asset management, corporate advisory. So you will see our fee income growing further in the coming quarters, hopefully, as our new business started or start contributing to the overall bottom line. Operating costs with investments in both the branch network as well as new businesses led to an overall increase in the operating cost by 11% as compared to last year. However, if you see our cost to income ratio, which was upwards of 50% in 2019, 20, and 21, where it peaked to 57%, has continued to decline and now stands at 48.3% as at the end of June 2024. Next slide shows the yields, cost of funds, as well as our net interest margins analysis. The graph on top left shows the overall yields, asset yields that stood at 6.4%. With increased interest rates that we have seen over the last 11 rate increases led to an overall increase in my yield to 6.4%. Our cost of funds, which went up sharply between 22 to 23, has now more or less stabilized at 4.13%. We did manage to manage our cost of funds in the year 2024. We had some dollar syndicated borrowings that I had mentioned, which we had repaid earlier during the year, that helped improve our dollar yields, as well as the overall increase in CASA has led to a largely flattish cost of funds. This has also helped. My yields have also been helped by some of the recoveries that we did during the year 2024, leading to an overall improved net interest margins from 2.08 to 2.27% as at the end of June 2024. Next slide shows the overall capital adequacy ratio. The capital position, our total capital adequacy ratio stood at 12.3 or 17.3 or 17.25%, with CET1 ratio at 12.9%, higher than the regulatory requirement of CET1 at 9.5 and total capital adequacy ratio of 13.5. The graph on the bottom right shows the dividend history. We declared a dividend of 7.75% to our shareholders as at the end of 2023. So to conclude, as I mentioned, fee and other income increased by 3.2% year on year. The fee to total income ratio stood at 22.8%. We continue to see an increase in our core fees. The new businesses that I talked about are expected to increase the overall contribution to our fee income in the coming quarters. Our net profit after tax increased by almost 20%, with both the top line growing as well as the fee and the total and the interest income growing as well. Cost to income ratio stood at 48.3% and continues to decline if I am to compare it with the cost to income ratio that we had seen in 2020, 21, and 2022. We continue to focus on increasing our footprint. Our total branch network stood at 119. As I mentioned, we follow a low-cost model, allowing us to have an improved customer reach, and it augments well with our strategy as we expand our product suite as well as new business opportunities that we are currently expanding on. We continue to focus on improving our asset quality with our NPL ratio now coming down to 5.11%. Our coverage ratios came down on account of the write-off that we have taken, however, continue to gradually increase with cost of risk gradually declining as compared to last year. Last but not the least, we continue to be supported by an experienced management team as well as motivated staff helping us grow our franchise. So with that, I will conclude my presentation and open the discussion for any Q&A that you may have.
Thank you, Mr. Vikesh. Please raise your hands if you have any questions.
Hi, good afternoon, Vishal.
Hello, am I audible?
Yes, Vishal, we can hear you.
Yes. Good afternoon to the team. Thank you for the presentation, for the call. Congrats on a good set of numbers. Just wanted to check, you mentioned, what is quite interesting, the bank strategy to grow the brick and mortar route. We've seen a lot of efforts on the digital space across the banking sector. But BankDhofar stands out in terms of growing the branch network. Could you just elaborate a bit of the strategy over there and sort of what target number of branches you have over the next, say, let's say, couple of years, and how you've seen traction on that particular end? Because we've seen the CASA improve. You've also spoken about fee income, which would be a direct cross sell as the customers grow. So if you could just touch upon that strategy.
Sure. See, I think from our point of view, when we look at the landscape in Oman, it's a very vast country. And a few years back, there was just one bank which had the presence in almost the entirety of the country, more or less. So which means for a citizen or resident of this country, the banking options were pretty limited. It was like they have to have a bank with which has got the widest coverage in the country. So I think we are basically addressing that want or need in the customer's side by going out and expanding in all the places. Currently, if you see, though the presentation showed 119 branches, that was as of June. Today, we are about 126 branches. So we are the second largest in terms of the network coverage in the country. And that puts us in a better position in terms of the customer acquisition. You heard the customer acquisition numbers, which Vikesh gave earlier. And also you saw the CASA growth. The second major issue that we faced as a bank was we were pretty much dependent on the wholesale funding, institutional deposits, and the like. So with the expansion of the branches, we are in a position to go out and get the most stable, sticky, better priced deposits in the form of CASA. So I think that drives the strategy. The key question really is, look, while the whole world is going digital and that's what is being talked about, why are you taking a contrarian approach to expanding branches, which is something which we grapple with as well. But I gave you the landscape and the particular banking context of the country. So the key question really is, are you able to do this expansion in a cost that is affordable? And are you able to manage your cost at the same time, get the advantage of the increased network? I think the jury is still out on that. But the trajectory of what we are doing is right. The traction in terms of the customer acquisition, the CASA deposits, and the other benefits that come with a wider network, the brand recall across the country. I'm pretty sure everybody in this call, you would have seen the BankDhofar branch or ATM, which has come somewhere close to where you live. So I think that's really the impact which it will create on the brand. In terms of expansion, we still feel there are pockets where our presence is not there, and that is what we are looking at to address. But I'm not fixated on a number where we see there is a need, we will do it, and we still see there is a need in quite a few places. So you will see that the bank fixing that gaps in the network that we see. Thank you.
Right, noted. No, I think it's a great point. And if you could just you touched upon sort of the funding base, given your previous situation. If you could just touch upon that in terms of, I believe just the entire banking sector has a huge sort of deposit base from the government. If you could just touch upon that percentage, how it's evolved with this branch expansion, and how comfortable the bank is in terms of having a diversified customer base today when it comes to deposits.
Yeah, I think ultimately it has to translate into the lower cost current and savings account base, and that's what we are focused on in increasing. And you have seen the growth in the numbers in the last 1 year on the CASA deposit. So that translates to that extent that we are growing on the CASA deposits. We don't need to take the high cost high cost fixed deposits, which approximately has got a 1.5% to 2% differential in terms of the pricing, if not more. So that differential pricing that we can get by going for more CASA deposit is what drives the bank, and that's what we are focused on. And hopefully that should translate into better income numbers for the bank.
Noted. Thank you for that. Last from my side, could you just give us some details or sort of your assessment of how the risk is in the system? We've seen, improvement in cost of risk across the banking sector. How do you see that evolving? You mentioned there was some write-off over there. So specifically for BankDhofar and in general in terms of the economy, is the buoyancy there on the ground, and what your comments are as one of the leading banks in the country? Thank you.
Yeah, sure. We had a legacy issue in terms of the non-performing loans. And if you see the last 2 or 3 from 22, 23, and even 24, the ECL of BankDhofar is one of the highest in the country in terms of what we are creating the provision. So we are cleaning up the legacy non-performing accounts. And I would say we are probably in the last stages of it. You will see it, you see it tapering down a little bit in 24 compared to 23. And we think going forward to 25, it will taper off further from where we are in 24. I don't think we will still be, quote unquote, the industry standard in terms of a number or a percentage yet, but we will probably get there towards the end of 25.
Noted. That's it from my side. Thank you so much. I wish you all the best.
Thank you. Thank you, Krishna. Any further questions from anybody? Yes, Joyce. Good afternoon, Joyce.
Hi, good afternoon, everyone. Thank you for the presentation. Some follow-up questions as to on this one. What's your loan outlook that you see for the next 2 years?
I think there are a lot of opportunities coming up in terms of government increasing its spending on projects. There are a lot of this hydrogen-related projects coming up, and various other opportunities which are there. So I think it's not absolutely any sector specific that we are looking at, but it could be particular projects that the government announces or the expansion that takes place. So I would say it's reasonably good compared to probably what we saw about a year back. So we are optimistic on the loan growth side.
Okay, so when you say you're looking at the government business side, what I've seen is during the course of this year, you had a small market share gain on the corporate side, but on the government side, there was a market share loss. So, could you please explain the reasons behind this, and what are your strategy on the corporate and the government credit side?
Yeah. So on the government side, in terms of the lending, as you know, the government of Oman is clearly focused on the debt reduction, the debt to GDP reduction. And a few days back, you saw the announcement which came in the newspapers about the debt to GDP, the debt position, which was around 16 billion a year back, is now reduced to 14 billion riyals. So a lot of it has come from the reduction of existing loans from the government entities or the government itself. And some of it we also got repaid or prepaid in that sense. So that's the reason that you are seeing it down, but that's pure government borrowing. But in terms of the government entities, our GREs and other projects, I think that still, depending upon the particular project or when it takes place, there are expansion that we are expecting to see.
Okay. And when we look at the asset quality, the stage 2 loan ratio has improved during over the course of last few quarters from a high of 22%, and it has reached to 20%. Could you please explain to us what are the key drivers for this improvement in the asset quality?
I think some of the loans which were classified as stage 2 in the previous quarters, we have seen improvement in performance on those loans, and that's essentially driving in the reduction in the overall stage 2 exposures. These have broadly moved to stage 1 and showing improved performance. So overall, we have seen a reduction in our stage 2 exposure. It's not only the stage 2 exposure, as I mentioned. If you see my restructured book as well, which was 542 million as at the end of June last year, stands now at 406 million. So there's another 136 million reduction in my restructured book. So overall, we are seeing an improvement in the overall economic pickup with the industry or the exposures that we work with, that has led to an overall reduction in my stage 2 as well as a restructured book. Of course, it constitutes of various names where we are seeing improvement, and that's what is getting reflected in the overall P&L numbers as well, Joyce.
Thank you. And see, on the non-interest income side, you have said that you are looking at diversifying your revenue streams and everything. So one thing that you have mentioned is your investment banking business. But I have another question is on, is there any further room for increasing or introducing new fees on the corporate banking segment? How do you see that possibility as a means of diversifying your income stream?
See, on the corporate banking side, introduction of new fees could be linked to introduction of new products or services for the customers. And when that happens, we could do it, because otherwise, on an existing product or service that you provide, because it's a very competitive market, so you cannot increase your rates on that. But of course, if you're doing a completely new service, and that's what we are looking at, new products and services, then you're able to make fee income that you never made before. That's on the corporate banking side. And the investment asset management, you're pretty much in that business, so you know the opportunities and things that come about. And we have set up the teams, and we are looking at various mandates which we are working on, launching funds and a lot of other things. So here, the key thing is a team that you have innovative enough to do something and get it done, they have the drive, and that's what we are focused on doing.
Fine, got it. And my last question is on, just wanted your thoughts on the falling, the potential reduction in interest rates going forward, and how is BankDhofar positioned for these rate cuts in 2024 and 25?
See, overall, if you see our numbers, financials for the year 2022, when most part of the year the rates were falling down, it was actually very beneficial to BankDhofar, because quite a lot of the deposits came from the term deposits, and when the deposit rates reduced, it helped us. So I think if rates were to reduce significantly, I would think it'll have a tailwind effect for the bank. But what percentage of rates will reduce and all that is basically anybody's guess. So we will take it as we go. But overall, while we could have repricing of the corporate loans as well when the interest rates reduce, but net, I think it should be a positive for BankDhofar.
So if I may add on that, how much, how quick will this get reflected in your asset yields?
Could you repeat the question?
How quickly should we expect the falling interest rates to get reflected in your asset yields?
I think it should take about roughly, approximately, you can take 6 months. Ballpark,
Right.
Depending upon when the review cycle comes for a particular account, but 6 months I would think is a fair guess.
It really depends. Further to add to that, Joyce, the asset and liability repricing schedule. But as Mr. Gopa mentioned, we do expect it over the 6 months period to start showing up in our net interest margins. And this is also a function of, with OMR rates being really a function of OMR liquidity. So, that's also something that plays a role in the overall cost of fund, for the business.
Yeah, exactly. That's the reason why I asked this question. Also, one more question that I can, if I may. So, strategically, which one is more important to you? Is it the funding cost, or will it be chasing asset growth?
I think increasing low-cost funds.
Right. Okay. Fine. Thank you very much.
Of course, loan growth is very important, but I'm saying between the two, I think low-cost fund is our priority.
Fine. Thank you. Thank you very much. Thanks for taking the questions.
Thank you, Joyce.
Okay.
Anyone else has any further questions? Okay.
If we don't have any further questions, we'll be concluding today's call. Thank you, everyone, for attending.
Thank you very much to everybody for taking your time off to be on the call. Really appreciate the questions and your presence in this call. Thank you very much.
Thank you.